and welcome to our session on performance and sustainability of microfinance institutions. Now, for any microfinance institution to be able to stay on and perform the mission for which they came in, that is to bring financial services to the poor, they must perform profitably, and then they should be sustainable into the future. In order to understand the drivers behind the performance of and sustainability of microfinance institutions, we're going to look at the role of subsidies in microfinance. We're going to identify the sources of funds for MFIs. We're going to look at the merits of domestic funding markets. We're going to evaluate the benefits of foreign debt. And then we're going to analyze the performance and sustainability of microfinance institutions. Now let's look at subsidies and sustainability. Typically, for a subsidy is any support that comes in to allow institutions to offer services, usually priced sometimes below the actual cost of providing those services, or make the reduce margins that otherwise would have been the expectations of the businesses or entities involved. So subsidies usually help to provide outreach to poor clients, because the normal assumption is that savings from poor clients may not be enough to provide the necessary credit support that poor clients need. But then there's a downside to the fact that subsidies are feared to make institutions flabby in the sense of being inefficient. For this reason, the assumption is that pressure is removed by the provision of subsidy. Pressure is removed from the microfinance institution. Pressure to deliver is removed, for which reason the push for efficiency gains may be compromised, and then they are not in a position also to experiment with new procedures. For that reason, we end up sacrificing dynamic efficiency in the course of reducing inequality in the short term. So here, this is a balancing act. And then overall, you can therefore say that it is better to maintain hard budget constraints rather than allowing the constraints and incentives to soften. In the early days of microfinance, typically, funding generally came from donors. That was the main source of funding for MFIs. Now, in recent times, the type of funders has expanded significantly to even include the private sector investor. Now, while required to finance expanded outreach, new products and channels. So what I'm trying to say is that the source of funding helps to expand outreach, provide new products and channels, and to move into new regions and markets. So it's important that MFIs have funding. Now, majority of the funding or the direct funding to microfinance is to support portfolio growth. So in essence, now that the microfinance have found their feet in terms of what their mandate is, then majority of the direct funding that comes to them is to support a growth in the portfolio. Now let's go back and find out, so who are really the major funders for these MFIs? We have public funders that include bilateral, multilateral, and local government agencies, and also entities we refer as development finance institutions. In SSA, that's Sub-Saharan Africa, by 2012, total funding had reached $12.6 billion, which is made up with 66% of that being deposits. Meanwhile, this was just 26%, in 2002. And then equity provides 21%, whereas it was about 67% in 2002. This is Chikalipa 2019. So strictly speaking, we can see that the funding frame has changed. We have more coming from deposits and now less coming from equity. Obviously, the motives and return expectations therefore begin to vary considerably by funding type, from some being a pure public good to others seeking pure profit. More now, the amount of private funding is growing quite quickly, albeit is still quite less than public funding towards the MFIs. Looking at the major funders, the bilateral agencies, these are usually country-specific governments that work directly with governments in less developed economies or countries. We have DFID and USAID. We also have multilateral agencies that provide financial support for economic and social development, like the African Development Bank, ADB, Asian Development Bank, World Bank, etc. We also have DFIs, we refer to these as development finance institutions, which focus on the private sector, investing both directly and indirectly. And we have entities like KFW, EBRD, and IFC. And then we also have private funders or foundations, like the Bill and Melinda Gates Foundation, NGOs like Action, institutional investors, i.e. pension and insurance, pension funds, insurance entities, that also provide funding for MFIs. Now, looking at the fact that foreign debt is also available to MFIs, the question to ask is, will it be better for the MFIs to finance or to fund with foreign debt? Now, it is clear that international investment in microfinance is on the rise. So many MFIs prefer foreign investors due to what appears to be lower nominal interest rates and sometimes subsidy elements. But over the years, it's clear that these financial institutions often overestimate the cheapness of foreign debt because they fail to fully account for foreign exchange risk. Now, you can look at it from this angle. You may get a foreign denominated debt that has very low interest rate. But given the way that, let's say, the Ghanaian cedi behaves or the local currency behaves in relation to their foreign exchange setup, by the time the foreign debt is payable, the depreciation that may have happened within the local economy serves to make the cost of financing way higher than the original plan, for which reason it can have implications for financial performance and sustainability. Another problem is that subsidized debt can lower incentives to mobilize deposits. Now, referring to our previous lesson, we realized the importance of micro savings for the poor. So by failing to provide incentives to come up with innovative ways of mobilizing deposits, this could serve to have rather negative externalities. Now, for which reason we tend to looking at the merits of domestic funding markets. Now, integrating microfinance seamlessly into domestic markets is the ultimate objective of building inclusive financial systems. So, when we use domestic funding as an MFI, it provides at least three advantages. One, it creates a source for deposit services which is highly valued by the poor and low-income people. Domestic funding will also help financial institutions to avoid foreign exchange risk. And then, because it is more likely to also come from commercially motivated sources, it is not one that we can just use for social developmental purposes, but is likely to push for innovative ways to give that out and also make good returns on those. Now, there's a reality that most domestic financial systems have excess liquidity. So, working through the domestic funding market will provide a way to tap into that excess liquidity and turn it into productive services. Now, there are also large and, of course, large numbers of savings deposits also hint at potential for mobilizing deposits on a massive scale from the poor. Other sources of funds that can be utilized in terms of the domestic funding market is debt from banks, certificates of deposits, or bonds, as well as even issuing equity. In general, it can be said that the MFIs have not taken full advantage of the enormous opportunity presented by domestic funding markets. Now, let's delve a bit deeper into the merits of deposit mobilization. Now, as the years have gone by, the regulated MFIs have begun to focus on domestic sources of funds and act as true intermediaries. True financial intermediaries, in the sense that the typical financial intermediary is supposed to take funds from the surplus saving units and then channel that to viable entities that are on the deficit side of the spectrum. So true financial intermediation will mean that we are linking the surplus units to the deficit unit, and that in itself creates development and welfare effects. Now, deposit mobilization has many benefits. It will allow the financial institution to better meet the needs of the poor, because we know that they require savings services and other range of services. It can lower the overall cost of financing, looking at the implications of exchange rate risk, etc. And it also allows the MFIs to diversify their sources of funds, given that the savings are usually more stable and reliable than donor funds, because donor funds can actually have shifting focus as and when the situation arises. Now, if it's obvious that using domestic funding sources as provide quite some good benefits, then can MFIs tap into domestic financial markets? Indeed, a few MFIs have placed bonds in their local markets, which means that even for Ghana, the MFIs can do same. So we have examples like Mibanco in Peru and WWB Cali in Colombia. Now, Bancosol, for example, also issued the equivalent of about 3 million USD bonds somewhere in 1997. And in 2004, ProCredit Bank in Ukraine issued about 6.8 million in 3-year bonds. These deals have also benefited from at least initial partial guarantees from donors like IFC and USAID. In 2005, Falu Kenya also issued some bonds on the Nairobi Stock Exchange to raise capital. And in 2011, however, only 3 MFI stocks have been listed, meaning that there's still potential for a lot more. We have Compatamos in Mexico, Equity Bank from Kenya, and SKS in India. But by 2014, 18, mostly in Africa, had also gone to list. So IPO, that's an initial public offer of SKS and Compatamos, were about 3 times oversubscribed with interest from the mainstream public. Now, this goes to show that there's a real potential for MFIs to tap into the domestic capital markets. Now, once funding has been raised and having already looked at the lending methodologies and the entire goal of microfinance, then we are going to box everything up and begin to look at, okay, so when it comes to financial performance of MFIs, how does it play out? Now, for an MFI to be managed well so that it can continue to deliver on its mandate of bridging the financial services gap to the poor, it must know how it is performing. So like any business, it must have a clear sense of its financial performance. To be able to do that, managers rely on financial performance information to understand areas of operation that may require attention, red flags, etc. Investors, who may also be able to be in a position to provide funding, use this to value and determine performance relative to planned targets and other potential investments, so as to decide where to put their money. Regulators also use this to measure compliance and support their oversight functions of financial services providers, whilst policymakers use that to structure and protect the financial sector and to ensure that policies and laws are appropriate and suitable to the situations on the ground. Now, there are several standardized frameworks to help monitor and manage financial performance. We can put these into about 6 groups. We can have efficiency and productivity. We can look at profitability, asset quality, capital adequacy, and liquidity. Now, for the typical MFI or financial institution, revenue is received through interest on loans and fees and commissions where applicable for services provided by the MFI. And these expenses usually come from funding costs in terms of how much it costs to raise the funds that it uses for onward lending, and other operational costs like staff, insurance, transportation, and then expenses it makes for loan loss provisions. Now, let's begin to look at monitoring of financial performance. When it comes to efficiency and productivity, you're looking to provide information regarding the rate at which the providers of microfinance generate revenue to cover the expenses. So that tells you how efficient they are and how productive. So efficiency in terms of the cost side, and then productivity in terms of output given a certain fixed input base. Then we're also going to look at profitability indicators that also look at the returns on assets, typically their portfolio, equity, and etc. So we're going to look at the relevant ratios as far as the MFIs are concerned, or the FIs. We look at first in terms of portfolio to assets, we can have the gross loan portfolio over the total assets. Now this typically is looking at the provider's allocations to the core activity of lending. So looking at the total asset base, how much money is being devoted to the core function. That also sometimes helps to find out red flags like mission drifts, where you find that a chunk of the fund or the money or the asset base is not being directed to the core mandate of the MFI. Then we also have operating efficiency ratio. Now this is captured as the operating expense over revenue. So in essence, how much you're spending in relation to the revenues that you generate. So it highlights personnel and administrative expenses relative to total revenue. So all things being equal, you want your expenses to be relatively smaller given the revenues. And then we also have cost of funds ratio. Now this has to do with the financial expense on funding liabilities divided by the average of deposits and borrowings. Now this tells you your blended interest rate for all of the funding liabilities. Then we also have the financial expense ratio. Strictly speaking, this is trying to look at how much interest expense you are incurring to fund your portfolio. So total expense bill in relation to the average gross loan portfolio. So you want that, all things being equal, to be relatively minute, meaning that the expense in relation to the gross portfolio should be small. Then you also have a cost per active client. So that's your total operating expense divided by the average number of active clients, and this you want to be relatively small, so that it means the transaction cost is relatively minute. That also begins to show efficiency in how you manage your services. Now you also have borrowers per loan officer. So how many active borrowers, because borrowers in a sense bring in revenue, in relation to number of loan officers. So in this case, you want to have a relatively large number of active borrowers to a relatively smaller number of loan officers, meaning that there's some level of efficiency. It means that one person is able to deal with a very large pool that brings in the relevant inflow of interest. Now, once we get to the profitability, we're going to look at portfolio yield. Now, this is about total cash received, etc., in terms of interest and fees on the loan portfolio, divided by the average gross loan portfolio. And this provides ability to generate cash on the gross loan portfolio. We have the operating profit margin, that is the net income before taxes and donations divided by the operating and non-operating revenue. So that tells you your profit margin. So effectiveness in managing cost. Then we have the ROA and the ROE, and that is usually the net income after taxes but before donations over average assets for ROA, and the same numerator over average equity for ROE. So these are profitability ratios. Now, when it comes to financial risk management, this has to do with the fact that there could be significant uncertainties regarding the inflow of revenue or the financial stability of the organization. And this usually, in managing financial risk, you're going to be looking at asset quality, the quality of the assets, and typically in this case, the loan portfolio, because that's the major asset and the credit risk it provides. Whether or not the MFI has adequate capital to support the kind of risk it is involved in, whether it has enough in the area of liquidity, and in totality, what goes into its asset liability management, that's the ALM. So capital adequacy, liquidity, and ALM normally are jointly managed within the function of treasury. So treasury management usually takes care of that. Now, the main rationale for a comprehensive approach stems from the fact that most financial risks are related. So credit risk may aggravate liquidity risk and capital adequacy risk. Now, this one way, when you have heightened credit risk, which means the possibility of default, and they actually do default, then it means that expected inflows will not be available, which then actually triggers the liquidity risk. And then now that there is a higher risk, it means that capital adequacy, that is also risk related, means that your capital may not necessarily be adequate to deal with the risk that is inherently affecting the MFI. Now, when it comes to asset quality or portfolio quality ratios, there are a number of ratios that we can look at. We can have non-performing loans as of 30 days past due. And so we are looking at the non-performing loans and the value of renegotiated loans greater than 30 days over our gross loan portfolio. So we want to see which proportion of those past 30 days in relation to our gross loan portfolio is not delivering. So that tells you, it gives you a measurement of non-performing loans. Now we also have the loan loss reserve, which tells us our impairments loss allowance, and that's usually the loan loss reserve over our average gross loan portfolio. It tells us what our expectations may also be in relation to what could go bad. It gives us a sense of our risk exposure as far as quality is concerned. Then we actually also have the loan loss provision, and this actually indicates the expense that we will incur to ensure that the adequate loan loss reserves. When it comes to capital ratios, we've got a number of them: debt to equity ratio, equity to assets ratio, capital adequacy ratio. So the debt to equity is just the liabilities over equity, and the equity to total assets is what we have: total equity to total assets. Usually gives us a sense of leverage and also therefore the risk inherent. Though banks or financial institutions are usually highly leveraged, it must be commensurate to the risk inherent. So the capital adequacy ratio also looks at total capital in relation to risk-weighted assets, and this measures the amount of capital in relation to our risk-weighted. So more risky assets would mean that there should be significant capital to buffer those. We also have liquidity, which looks at loans to deposits. So how much gross loans in relation to deposits, and it tells us the relative portion of the portfolio that is being funded by deposits. We have liquid assets to total assets, typically captured as cash over total assets. And we also have the asset test ratio, in this case, cash plus trade investments divided by the demand deposit and other short-term liabilities. So this also gives us a sense of liquidity within the MFI. Now, typically, an MFI can only deliver on its function when it's operationally sustainable. So there's a need to be able to measure the ability of the MFI to cover its operating expenses given its operating income. So MFIs that are able to cover the operating costs are regarded as more sustainable. And how do we determine that? We look at their total operating income and divide that by the interest expenses, their loan loss provision, plus the administrative expenses. Now, once the total operational income can cover that and more, then we say that this MFI is likely to be more sustainable. So once you're managing an MFI, if your total operational income is unable to cover your interest expense of funding, also the loan loss provision and administrative expenses, then you need to begin to re-engineer the business model and look at how to reverse that. Financial sustainability is also captured as in the PAR, which examines the percentage of the loan portfolio of the MFI that is overdue or is likely to be exposed to significant risk in the future. So it's more of a portfolio at risk. So we are looking at principal at risk. You're looking at the total loan principal on overdue or delinquent loans as a proportion of the total loan principal outstanding. So here looking at the principal, not necessarily the including any adjustments on interest, but you're looking at the principal on overdue loan amounts in relation to the total principal on the whole portfolio. So you really want a very small amount of your principal to be overdue, in which case that is a very small portion to be at risk. So when you have a higher PAR, it suggests that you have credit management problems. You may need to go back to the board or the management committees and begin to brainstorm on ideas on how to move forward. Now, to a large extent, MFIs were also created to alleviate poverty, and poverty is also a social problem. So there's a need to begin to look at MFIs in the area of social performance management. Because for many MFIs, social performance and development impact are as important as financial performance, because they are really ongoing concerns of mission drifts as many of the institutions are beginning to move away from the poor and begin to serve higher income clients, for which reason they are performing well in terms of financials, but in terms of the social mandates, they have drifted. Then there are also concerns of over indebtedness because of some interesting dynamics as far as the micro credit schemes are concerned. And so when it comes to that, it means that social performance dynamics are missing. And then social performance management also helps to ensure that the mission of helping the poor to manage their financial lives remain intact. Social objectives are typically following social mandates in terms of making lives better for the society. So some of them include serve increasing numbers of poor excluded people by broadening and deepening outreach, improve the quality through systematic assessment of the client's specific needs, create benefits for clients, families, and communities by empowering women and others, and also improving social responsibility of providers towards employees, clients, and the communities at large. So that brings us to the end of this session on performance and sustainability. Now, some of the things you'd want to go back and review: the role of subsidies in microfinance, identifying the sources of funds for MFIs, discussing the benefits of deposits mobilization, and also working within the domestic market setup, and also looking to briefly describe measures that you would use to evaluate the performance of MFIs, including at least one ratio in each category. See you in our next lesson. Bye.